I think adding value and not just like from a real estate perspective, helping people learn, improving these apartments that I'm buying. It's nice when you buy a heavy value add and it just looks terrible. And you're like, oh, this is not that hard. Like landscaping, paint, roofs, like we
Right.
can make this place look pretty nice. Just adding value across the board.
So the big question is this: how do real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we conservatively grow our real estate business to support our families, finally leave the corporate rat race, and build a legacy? That is the question, and this podcast will give you the answers. I'm Ed Matthews, and this is Real Estate Underground. Greetings and salutations, Real Estate Undergrounders. It is Ed Matthews with the Real Estate Underground. Thank you again for joining us and making us a part of your day. With me today is Chris Lento from EM Capital, based up in my old stomping grounds in Boston. Chris, welcome to the show. I'm excited to have this conversation.
I'm happy to be here.
Yeah, great. My history is I spent a bazillion years in the tech world. And so I was bouncing between mostly Silicon Valley, but also my wife and I actually had our two daughters in Boston and lived up there for about 10, 12 years. I'm green with envy because I love that place. So Chris, for those folks who haven't come across EM Capital yet, I want you to tell us about yourself and your company.
Yeah, sure. I was in aerospace engineering for 17 years. So tech adjacent, I would say. So,
It's pretty technical.
not cutting edge tech, defense industry stuff. In parallel, I was doing small multifamily investing in the Boston area the entire time. So 3 families, 5 families.
Yep.
Always was trying to figure out how to get that to be my full-time career, but didn't really see a path and didn't think about it too seriously probably the first 10 years of my career.
Yep.
And then, as I figured out what the entire career world was in the defense industry, started plotting a course to transition. So that happened in 2017. We're focused exclusively in the southeastern US. So I got out of all my Boston area properties, rolled them, 1031 exchanged them, sold them into properties in North Carolina down to northern Florida. And we focus on now 100 plus multifamily, $10 million to $50 million acquisition price in the major markets of the Southeast.
Okay. How many markets are you in right now?
We're in 4 markets.
Okay.
So we're in, Charlotte, Raleigh, Columbia, South Carolina, and Atlanta.
And I'm curious about what drew you to those markets. Like what in particular kind of piqued your interest?
Yeah, we're really looking for population growth, job diversity, and volume. If there is one city that you could just focus on and get the deal volume to be able to grow, that would be great. And Atlanta is almost that.
Right.
It's a big market, but there are limitations and the downturns and people aren't selling here. So we want a number of markets to have enough deal flow, but we want a small enough number that we can really understand those markets and develop relationships in the markets and have property managers and vendors and really know the neighborhoods.
Yeah.
So we're looking for population growth and economic diversity.
Okay.
And then size, right? Like we don't want anything below, say, 250,000 people.
Target rich demand, target rich environment for new residents.
Exactly.
Okay. And then in terms of, I think when I looked at your website, you had just over 800 units under management, right? Does that sound right?
Yep, that's right.
So is it semi-equally dispersed among those 4 markets, or is there one market you're a little heavier in?
Yeah, we're heavier in Atlanta right now. We have 300 units, actually 420 units in Atlanta, and we're under contract for another property in Atlanta. Yeah, the Atlanta market has a lot of assets, huge population growth, and a lot going on there.
Yeah, it's a huge growth opportunity. I'm curious about the one thing that when I talk with operators and investors who target the Southeast, the insurance risk has been a pretty significant challenge for a lot of us, myself included. And I'm in the Northeast. My portfolio is here in Connecticut. I'm curious how you are navigating that.
Yeah. So anything coastal is very difficult due to hurricane risks that have really gone up. Atlanta, it's interesting you raise that because it has its own kind of issues. One problem the Atlanta market has is that it has a very high cap on liability for the property owner. So if someone gets injured on your property, one resident hits another resident with their car on your property, you have a lot of liability. So because of that, the insurance is higher than you would expect. And really get good insurance brokers that really know that, manage the things that you can, meaning what are the insurance companies looking for in those policies to bring your premiums down, and then underwrite it correctly. If that's the cost of the market, then you have to make sure that you're aware of it and the risks as far as increasing and put that in your underwriting upfront.
Yeah. So I've been a limited partner in Atlanta, but I've never operated down there.
I think it's Georgia.
Okay.
So I think Florida had a somewhat similar law with not as high of a exposure, and they've recently changed it. And my understanding is Georgia's talking about it. I don't know when that will happen, if it will happen, but there's a big demand, right? The people that are lobbying are the owners, and they don't want to be liable for non-related incidents on their property. If you're at fault, if you have a sinkhole or something, that makes sense.
If some dude drives over somebody a foot in the parking lot,
you have $3 million exposure to that. Really know your insurance market. It's crazy how much it changes state to state.
Yeah, indeed. Here in Connecticut, we got walloped with significant increases, but they were all storm related. And the thing is that we've had one hurricane make landfall here in the last 30 years. Exactly. In 91 or 92, we get the residuals, right?
And actually, if you think about it, a lot of the southeastern population is not near the coast. And because all the northeast population is near the coast.
Correct.
Yeah. Charlotte and Raleigh are 2.5 and 3 hours away from the coast. Yeah. Columbia is at least an hour. Atlanta's probably 2 hours. So they're all inland. Right. I guess Charleston, South Carolina is the only kind of major population center I think of.
Yeah, Myrtle Beach, maybe something like that. So as far as your buy box goes, what does that look like? Or what class are you looking at? And what are some of the attributes that you're keyed in on when you find a potential deal?
Yeah, we're looking for 1985 or newer, $10 million to $50 million acquisition price. Like I said, in 250,000 person population area or greater, with significant above average job and population growth. And then on those older units, if it was right in the line, 85, if it has 2 bedrooms, I'm looking for a 2-bedroom, 2 baths.
Okay.
You could renovate a 2-bedroom, 2 bath and give it one upgrade and give it a new feel. But a 2-bedroom, 1 bath, no matter what you do, it's a 2-bedroom, 1 bath. And I think that's also an indication of the quality of the property when it was built. So if in 1985 or 6, someone was building a 2-1, they were going cheap.
And so when you say cheaper, you mean the mechanicals are their shortcuts or something?
I mean, targeting a lower price point on the rents, and what else is inexpensive? Plumbing, wiring.
What's inside the wall.
Appliances have probably already been changed, but roofing, structural. If you find a 2-bedroom, 1 bath property from the mid 80s, it also has a non-interesting aesthetic. It's basic. Right. It doesn't have any gables or any architectural distinction.
So architectural distinction, are you looking for unique properties that are curb appeal, or is it something else?
I wouldn't say we're looking for trophy properties by any means. We're looking for properties that have a value add component, that the numbers make sense and we can underwrite realistically.
Yeah.
You have to underwrite realistically, in my opinion, with a realistic underwriting list. Hey, this is what we really think is going to happen, what we really think the exit price is, the market's going to do, and then add in a little factor of safety.
Sure.
To make it a little more conservative. And that's where we like to sit. A property that fits that box. We have a 2022 under contract right now in Atlanta. Class A. Yeah. Kind of on the line, I would say, but it's new. So it's almost by definition a class A, but it's not like,
what does that look like? Is it a lot of class?
The portfolio is A's and B's. Yeah. And on the A side, they're like, we like to think of them as A minuses. Like we're not pushing the market in rents. We're not the brand new thing with a rooftop pool or anything like that. But the A's they're relatively new, or they're refurbed older buildings that are newly renovated. Clean. So we can keep our prices $200 below the local class A's, but have a very similar experience.
Smart. And when you're doing it that way from a strategy perspective, obviously you're looking to push occupancy. So I'm curious, what do those numbers typically look like in the markets that you're in?
We'd love to be 95 plus in all the markets. Right. Atlanta right now is hovering around 92. Agency market 91, 92. Yeah, that's not bad. We do property in Baltimore that had struggled when we bought it, and a lot of bad debt, and a lot of tenants that didn't meet the credit requirements, and the prior owner just filled it. So we struggled there, and now we're at 98, which is crazy. We're in the process of increasing the rents. To some degree, you want to be, in my opinion, at the 95, 96 max level. Otherwise, you're not getting enough churn and you're not keeping up with the market.
And then you stagnate, and that's a problem too.
Exactly.
So I'm curious about the Baltimore property. It probably applies to a lot of your properties. When you're inheriting residents who don't fit your resident profile, what's your strategy there? How do you handle that?
Well, you need a strong property management team. So we do third-party management, meaning that we hire local property management to run the property. We try where we can to use the same property management companies. We have a good relationship with a reasonably large Southeastern company that does a number of our markets, but not all of them. And then we're very hands-on and we focus on bad debt. Every week we have a meeting with our property management team. And one of the tabs of our spreadsheet is just a cut and paste of their paid receivables, 30, 60, 90. And we have notes next to each one, like where are we with this person? Who's talking to who? And that's a big focus of the property management team. And they're incentivized to drive the bad debt down. Yeah. It's a process. It's not going to be fixed in 2 months. It's going to take, what are the local eviction laws? How much you want to work with people? What are programs that are out there for people that are behind on rent? And it's a constant kind of weekly, all right, what's next?
Yeah. Honestly, I usually find that it's best case 12 months, sometimes 18 months to stabilize a building.
Oh yeah, I agree. 12 months is, you're doing great, I think.
That's a home run.
Because at the beginning, it depends behind the tenant base is. But for those first maybe 6 months, it's hard to get high quality new tenants because the property has this certain feel that like, and it can be a culture too. Hey, you don't need to pay for 3 months here. And then they start sharing the information and you're like, oh, how do I change the dynamic? So yeah, 12 months, I agree with you, is on the positive side.
Yeah, that's great. So tell me where you're taking the business now. So you're at 800, you've got a complex under contract. What's next?
We're looking to continue to grow. 2023 and 4 were just slow years, I think, for everybody. And so we didn't grow. I think got one deal in those 2 years. So it was just really tune up the deals you have, handle some refis in turbulent markets.
Keep swimming.
Check the 10-year treasury more often than you think you should have to. Like multiple times a day, exactly, which is crazy. It's a 10-year treasury number. So yeah, we're back in acquisition mode. Like we're seeing a lot more deals come on the market where our investors have a more positive feel. There's just definitely a change. There's still some wait and see going on, but I think to some degree, the lenders, a lot of these bridge loans are finally coming due for real. The lenders like, all right.
Yeah, this time we mean it.
Interest rates aren't coming down. I mean, I feel like the sentiment at the end of 24 was, 25, the interest rates are just going to come down.
I'm curious where you think rates are.
So I think they're going to stick around where they are now for a while. I don't see anything pushing them. The Fed can lower the short-term rates if inflation doesn't go up. And that would be, I think, good for construction loans and for adjustable rate loans. But that's not really tied to the long-term loans, which most of the loans I like to get are based on. And really, the short terms are too high relative to the long terms anyway. I think they're going to stick around and that prices are going to have to adjust. And
I think you're 100%.
We'll inflate the rents out of this. It'll be a little time for everyone's income to go up. And then, okay, now the deals start making sense a little bit more.
Right on. So you're probably raising a little more capital, right?
Oh, yeah.
You put it under a 30, 40 year.
We used bridge debt on some heavy CapEx properties in 2022 when, frankly, if you weren't using bridge debt, I don't know how you made a deal pencil. We got out of one of those last December and it worked out. We're working on one right now, rolling into some permanent financing. But right now, no, we're not looking at bridge debt at all. The rates are so high. The interest rate caps are so high, but we're raising, we're at like loan to value, maybe 65, 62% on some deals.
Yes.
Yeah. So we're raising a lot of equity and we're doing more preferred equity,
right?
With either institutional partners or family offices that'll get us up to 85% LTV. And then we raise limited partner equity for the rest.
Yeah. Nice. That's a smart way to do it. It's so easy to get over leveraged in a market like this. The fact, I agree with you on the interest rates. Everybody was like, survive to 25 and then everything will be okay. And we'll get back into the fours. And it's just historically where the interest rates are right now today, historically is right down the middle of where it has been 50 years back.
And it's not that bad. It just feels so painful compared to 3 years ago.
Yeah. 3 years ago, 4% interest rates made all of us look like geniuses. But I think it's time to actually play where the normal, historically, the big boys play. And I have a mentor who told me, look, if you can't make a deal pencil at 6.5%, 7%, that might be a you problem, not a building problem or a market problem. And if it was easy, everybody would do it. But the fact is that there's other levers you can pull to get creative to be able to make a deal pencil and do it responsibly and conservatively.
Yeah, no, I agree. And it's right now, it's been changing so much, right? In the last, say, 5 years, it's the constant, like the financing and the debt structures. It's a constant churn. You have to stay on top of it with your lender.
We have standing lunches like at least once a month where I'm there to buy him a turkey sandwich and, all right, spill it. Tell me what's going on in the world. Okay. Hey, why don't we get into the final 5, our lightning round? I love to learn how leaders like you think and how they approach their day and also their businesses. First and foremost, purpose, right? I think that, at a certain point when you reach, and I think you're probably beyond it, I'm guessing, but where your personal mortgages are paid, the kids' colleges are either on track or locked away and ready for them, the cars are paid, you've done all the responsible stuff, and now you're doing some of the fun stuff. And nevertheless, you get out of bed on Monday morning like a shot and you're fired up to go to work, right? For me, that's purpose. Coming out of the tech world, I met so many multi millionaires and a few billionaires. And for them, there was a certain point where it just stopped being about money. It was something else. And so that's what I'm curious about is from your perspective, what gets you out of bed on Monday morning?
I think at that level, thinking about it, it's constantly learning. Like I like to constantly learn new things, dig into the details, whereas real estate's constantly changing and the economy's changing and the markets are changing. It's just always exciting to meet new people, learn new things. And I learn by doing.
Yeah.
As we get into a deal, we're going to 1031 our syndication in this deal. Okay. How do we do that? Who do we need to meet to figure that out? Okay. Who are the right people? How do we learn this? What's the best practices? How can we be better than the next guy on this? How can we make it smoother? How can we improve the relationship and everyone wins? So I think for me, really constant learning environment is what I.
Okay, cool. And we don't get to where you are. I don't get to where I am. And the folks that are listening probably didn't get where they are without mentorship and really good coaches and people who, early on and even to this day, take an interest in our success. And so I'm curious about the mentors and coaches you've had in your life and teachers for that matter. And what's the best advice you ever got and who gave it to you?
So I've had a number of mentors, but I've also done this coaching program that was really valuable called Strategic Coach. And two things came out of it that really stuck with me. And one is this concept of who, not how. I'm like someone who wants to know everything and do everything.
You're an engineer.
So at least figure it out. And just the idea that everyone has a unique ability and that if you hate doing something, one thing I just can't stand doing is anything related to lender reimbursements. Just find the whole process annoying, tedious, and no one knows what they're doing. And
right.
Some people don't mind that. Some people kind of like that. So find that person and have them do it. I'll focus on the stuff I want to do. And that whole idea, you don't need to know it and train someone. What you need to do is find someone who knows it or it lines up with what they like to learn. And then partner with them, work with them, hire them.
Yeah, I'm a numbers guy, but I don't like
books.
We hired a crackerjack controller and accounting person, and they are awesome.
It's great seeing someone who loves it, right? You're like, this person loves this.
An accountant. So I know the personality types. It comes in handy. I'm also interested in lessons learned. I fundamentally believe that we learn more from our mistakes than we do our successes. And I'm curious about a professional decision you'd love to have back. And what did you do to navigate it and figure it out and even recover if that was something that you had to do?
Yeah, we had a deal where we had to go hard in order to win the deal. And we had confidence that we could raise the capital, but it wasn't by any means in the bank. And that's part of this game, right? I want us to pull all the different pieces together and they're not all there yet. You have to be confident that this will come in and convey that confidence to the other group. And so I would say we got a little bit over our head with the amount of capital raise. Luckily, it was last fall where capital was scarce. We had the election. That's when the 10-year started going up to people's kind of surprise.
Yeah.
We weren't the only ones that were having this problem.
Sure.
We were able to work with the seller to negotiate some extensions. And then we were able to pull in some pref equity to fill the gap. But I would say the lesson was have an A, B, and C plan. And actually think through it with you and your partners ahead of time. Okay, if not this, then what's next? Because that scramble feeling when you have money on the line.
I'm also interested in how leaders like you take in information and how you grow. One of the things you said earlier is that you're always looking to learn. So are you a physical book person? Are you an Audible or something else? And who are you paying attention to these days?
I listen to a fair amount of podcasts, often depending on which podcast on 1.5x because fair amount of flow. I do read a fair amount of real estate and business books, but the same thing. I feel like maybe 1 out of 10 you want to get it could be a 10-page pamphlet.
Right.
So I like just fly through them. Like, where's the thing? Yeah. This person has one thing or two things that they're probably have a great idea. And there's why I should believe them.
I always skip the first 3 chapters. Instead, like story and something else.
But where's the nugget? I do read a fair amount of books. I listen to podcasts. I read the Wall Street Journal real estate section every day, if not every other day. And then just talk to people. A lot of it's talking to people. It's like we said earlier, the lenders see a lot of different variety of people. Your lawyers often have good ideas, see different structures.
Yeah, it's amazing what they see because they have such a broad view into the market. because their client base is diverse. So
Right.
they're seeing a whole bunch of stuff that never hits your radar unless you ask.
Yep.
Yeah. All right. Last one. How do you define success in your world?
I think adding value, and not just like from a real estate perspective, helping people learn, improving these apartments that I'm buying. It's nice when you buy a heavy value add and it just looks terrible. And you're like, oh, this is not that hard. Like landscaping, paint, roofs, like we can make this place look pretty nice. Just adding value across the board is my answer to that.
Chris, congratulations on all your success. I'm really excited for you, and I can't wait to see you continue to grow, and maybe you'll let me become one of your investors someday. But
Absolutely.
How do you spend your time?
I have an 8-year-old daughter. She's pretty active. So the winters, we do a lot of skiing. We do a lot of bike riding. We just got a dog. So that's a whole new thing. So a lot of family stuff. We go to the beach in the summers. Yeah.
He's married to an amazing woman, and they decided not to have kids. When he's exciting, right? He's got a boat and he restores cars, all the cool stuff. He's literally that cool uncle that everybody wants. But he asked me once, what do you do for hobbies? And I'm like, you see that little girl over there and the taller one over there? Those are my hobbies. I do swimming, I do dance, I do softball, I do soccer, I do beach, and whatever else they want to do.
And we do a fair amount of traveling too.
Yeah. Best thing ever.
We like that.
I just have a child, that is, and especially daughters. I'm partial. I'm a girl dad, so I'm like you. Hey, Chris, so if folks want to learn more about EM Capital or want to get to know you, what's the best way to get in touch?
You can check me out on my website at mcapitalgroup.com. And then I'm very active on LinkedIn. Reach out to me on LinkedIn and we can set up a call.
Awesome. Chris Lento, thank you so much for your time today. It's really good to see you, and continue good fortune.
Great questions. Good conversation. Thanks.
This has been the Real Estate Underground. Don't forget to rate, review, and subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.
This has been the Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.